Welcome to StockSynops, your go-to source for AI-powered breakdowns of the latest stock earnings. Today, we're diving into the recent earnings report from FuboTV. I'm Chris, here to walk you through the key highlights, and joining me is Jessica, ready to ask the tough questions. Let's get into it. All right, let's kick things off with the big picture. FuboTV just reported their Q1 FY 2026 results, and it's a landmark quarter because of their recent business combination with Hulu plus Live TV. This merger has really transformed the company into a major player in the live TV streaming space. On a reported basis, global revenue came in at $1.549 billion. That's a whopping 40% increase year over year from $1.106 billion. But to get the full story, we look at pro forma numbers, which account for the combined business. Those show $1.683 billion in revenue, up 6% from last year.
Whoa, 40% growth sounds impressive, but that pro forma 6% is more modest. Is this merger inflating the numbers, or is there real organic growth here? And what's the deal with subscribers? Did they hold steady post-merger?
Great questions. The reported jump is indeed boosted by the Hulu integration, but the pro forma gives a like-for-like comparison, showing steady growth in a competitive market. As for subscribers, the combined North America total sits at 6.2 million, which is actually down slightly from 6.3 million a year ago. That's a minor dip, but it's worth noting. On the profitability front, though, things are looking up. Reported net loss narrowed to $19.1 million from $38.6 million last year, and pro forma net loss improved to $46.4 million from a much deeper $130.4 million hole.
Narrowing losses is good, but still losses. EPS came in at a loss of 2 cents. Did that meet expectations? And with no profits yet, how sustainable is this path, especially if subscriber numbers are slipping?
EPS did miss some analyst estimates by a bit, but the improvement in losses is encouraging. Even better, pro forma adjusted EBITDA turned positive at $41.4 million, nearly double the $22 million from last year. That's a key metric for streaming companies, showing they're managing costs better. Highlights include the Hulu merger, creating a scaled platform, plus a new arrangement with ESPN to resell Fubo services and integrate into their digital properties. That could lower acquisition costs and boost visibility. They also launched pay-per-view, which saw 200% sales growth quarter over quarter, tapping into superfan monetization.
ESPN tie-up sounds promising, but ESPN is part of Disney, who just handed over Hulu. Any conflicts there? And on PPV, is that enough to offset potential churn if content deals go south? I mean, they removed some NBCU programming recently. How did that impact subscribers?
No conflicts mentioned. It's all about expanding reach. The NBCU removal did lead to price reductions for affected users, but the impact on subscribers was better than expected, reinforcing their sports-first focus. Another win, they're migrating ad tech to Disney's system, which should improve ad yields and fill rates. Advertising revenue on pro forma was $123.5 million, though down slightly year over year, but the unified sales with Disney Plus and Hulu could turn that around.
Ad revenue down? That's concerning in a streaming ad boom. With competitors like Netflix and Amazon Prime Video ramping up ads, how does Fubo stand out without eroding user experience? And speaking of competition, the live TV space is crowded. YouTube TV, Sling, etc. What if this merger doesn't deliver the synergies everyone hopes for?
Fair point on ads. The slight dip might be transitional, but the tech upgrade should help. Fubo differentiates with its sports-centric offering and flexible packaging. On the merger, integration is ongoing, and they're focused on unlocking value through combined ad inventory and product innovations. Cash position is solid at $458.6 million, giving them runway.
Cash is king, but burning through it with ongoing losses could be risky. No guidance was provided. That's a red flag, right? Investors hate uncertainty. How might economic factors like inflation or cord cutting trends affect them long term?
Absolutely. No guidance does add uncertainty, especially post-merger. They said they'll revisit as visibility improves. Economic pressures could impact subscriber retention, but their value proposition, bundling live sports without cable, positions them well against cord cutting. Challenges include integration risks, content renewals, and competition, but the scaled subscriber base and positive EBITDA trajectory suggest resilience.
Resilience is one thing, but overvaluation worries me. With shares reacting mixed post earnings, is Fubo a buy, or are there too many unknowns like regulatory hurdles in streaming?
The market's volatile, but the merger creates opportunities. They're even planning a reverse stock split to align with their size. Overall, it's a step toward profitability in a growing market. To wrap up, FuboTV's Q1 FY 2026 earnings showcase the impact of their Hulu plus live TV merger, delivering strong revenue growth. $1.549 billion reported, up 40% YOY, and improved profitability metrics, with pro forma adjusted EBITDA at a positive $41.4 million. Subscribers held at 6.2 million in North America, though a slight dip highlights retention challenges. Key wins include the ESPN partnership and PPV success, positioning Fubo as a sports streaming leader. However, no guidance introduces uncertainty and risks like integration hurdles, competitive threats from YouTube TV and others, content costs, and economic factors could pressure margins. While losses narrowed significantly, ongoing red ink and ad revenue softness warrant caution. Long term, the scaled platform offers growth potential if synergies materialize, but investors should watch subscriber trends and ad yields closely. Overall, it's a balanced story of progress amid transformation, promising for those betting on streaming's evolution but not without risks. Thanks for tuning in to StockSynops. Subscribe for more AI driven stock insights.